Now, I mentioned that cost of capital formulas are a little bit different in big business. And any finance course that you take, if I didn't mention something called the tax shield, I'd be a little bit wrong. So I have to talk about it. The one complication when we talk about the true cost of capital formula is that interest is tax deductible. Remember, it shows up near the bottom of our stepped income statement. And after interest is expensed, we pay our income tax. Now, we only have income tax if we have a profit, but at the end of the day, the cost of our capital is affected because it actually is a tax deduction. I'm going to explain this a little more, how it happens. The formula gets one little piece added into it, and all the other things stay the same. Okay, so we have the rate of the taxation, the income tax. So typically in Ontario, we're around 18, 19%, something like that. For the example, I'm going to plug it in at 20. And just recognize that what's happening is we're having 1 minus the rate of the income tax, which means we get 1 minus, for instance, 0.2, which leaves us 0.8. So that whole top part of the equation on that right hand part of the WACC is only worth 0.8 instead of 1.0. So that's going to lower, okay, that's going to lower the cost of our capital from the bank. So we're going to have a look at that. I'm going to leave everything else the same. Okay, we're just restating the previous slide. The cash cost of the debt, okay, the interest is tax deductible. Right? So if we're going to pay interest, we actually pay less cash to the government at the end of the year because we make less money. Okay, now this is true of any expense. It actually generates a bit of what's called a tax shield. Okay, I had that in the previous slide. Another way to put it is that if you have a higher expense, say it's rent even, you're going to have less profit. And because you have less profit, you're going to pay less income tax. This is kind of a side benefit, and it worries me if we start talking like that in small business, because it means that we start thinking about, oh, it didn't really cost me anything. Okay, and I get this argument from people who try and sell me charity golf tournament events and things like that. Say, well, John, it all comes back in income tax. No, it doesn't. Okay, if I give the tournament $100, I only get $20 back. So what are we talking about? We're talking about whether or not it comes out of my left pocket or my right pocket. It still comes out of my pocket. The $100 is out, it's gone, and it's still an expense. It's $100 out the door. Whether or not there's a tax benefit is irrelevant to my way of thinking, to the conversation, in that maybe at the end of the year that donation only cost me $80, but I don't want to think that way. It's a dangerous game to play, and we start thinking about, oh, we're making more money than we're really making, and all sorts of silly arguments like that. Don't want to go there. So we're going to just say, okay, let's go through this exercise of 1 minus RT, but let's not count on the actual tax shield generated, because it's pretty small. In big companies, big transactions is going to be millions, but we're up to not that much. Okay, so again, if I'm going to take $100 and I have a earnings before income tax and the interest of $100, we don't have any interest, I'm going to pay $20 in income tax. Okay, this is just a short calculation at the bottom of our income statement. You guys have seen this all term, so shouldn't be surprised. All right, now if I have $100 in debit and $10 in interest, my profit is going to be, think fast here, driven down to $90, and I'm only going to have $18 in income tax. Okay, so 100 minus 10 times 20 gives me $18 in income tax. So the interest paid reduced our tax bill by $2. It also reduced our profits, don't forget that, by more than that, but it gave us a $2 tax shield. Okay, gave us a $2 tax shield in this example. And as I mentioned before, every expense generates a tax shield, but remember, it's only 20%, and we really shouldn't be counting on that as as profits or anything like that. Or lowered expenses. That's just a bad place to be. Bad calculation. Think of it as a Christmas present that somehow the numbers of the CCRA and business in general have worked in your favor, but you're never ever really going to see this tax shield. It's just the way it works. Don't count on it. Don't count it into your calculations or anything like that. Just be aware that it exists. We're doing a finance course, and we got to talk about tax shield. By way of example, I'm trying to stick to the $100. If we've got revenue, and this is the mini income statement, if we got revenue of $250 less our expenses of $150, gets an EBIT of $100, and we don't have any interest. Our earnings before taxes is $100. Our tax is $20, so our net profit's $80. Okay, simple. Now, on the right side, if we've got revenue $250 minus our expenses, we've got EBIT of $100, and we've got a $10 interest bill, that means our earnings before taxes are $90. Okay, so if our taxes are 20%, on the $90 we pay $18, and our net profit's $72. Okay, and you would think intuitively it might be $70, but if we still had the same $20 income tax as we do in the left column, that would be the case. But we have $18, so we've paid less tax. We have a tax shield of $2, but remember, we already spent $10 more than we did in the left column, so it's kind of a false gain. And this is one of the things I see people doing, and it really makes me worried. Okay, calculate it the full pop. That way you're being conservative. Better way to do your calculations. Now, sometimes we're going to buy something that we really don't get a return on. Okay, so say a truck. Now, sometimes when we buy a warehouse and we need it to store our goodies, our inventory, and that sort of thing, we have to look at our alternatives, or what we're doing now. Maybe we're renting a place. So we have to look at the money saved. Okay, if we can store more stuff and have more inventory and make more money because of it, then we can look at our increased cash flow because of that investment. Okay, so this is a sort of an interim way of thinking as well on our capital expenditures, because a lot of places and a lot of economic conditions, for instance, I'll look at warehousing. We can rent warehousing in London, Ontario for about $3.50 a square foot per year. But to build a warehouse typically costs $17 to $20 a square foot. So you've got to think, okay, is it better for me to rent or is it better for me to build? In this sort of case, this is exactly what we're talking about when we talk about capital budgeting. Okay. Sometimes we have to get a new roof. Okay, we won't know of any return on that one except lowered insurance bills maybe, or water damage costs, that sort of thing. So there are some investments we can't really calculate a return. All we can do is say we've lowered the risk, which in some cases is enough to make it worthwhile anyway. Now the hurdle rate is just one thing. We've been using around 10% for our little example here, and that's just strictly the cost of capital. But when you get into businesses that are a little more risky, or your product line or your services that you're trying to develop are a little more risky, whether they'll make money or not, we have to add more to the cost of capital. So for instance, if I'm in the business of developing computer chips like Intel or something like that, we might have a WACC of 50% or hurdle rate of 50%, something in that neighborhood. Now it'll have factored in, for instance, the 10% of the actual cost of the money, but then we're adding in a risk factor as well. And of course, 50% in some businesses is very standard, and especially in the electronics business, because things change so quickly. You spend money and engineering time developing a chip, and you have to get that money back fairly quickly because that chip might only be good for 18 months before you've got a new one in development coming down the pipe, or a competitor does. So in that case, your cost of capital, or actually what we call an internal rate of return, has to be higher. The hurdle rate has to be higher than our actual physical cost of capital. And these are things we have to think about every day, and usually just in bigger businesses.